crazy cheap, 20-cent dollars out there, nothing like late '08, early '09. On the other hand, the world then was on the edge of Armageddon. Things could have gotten really, really bad, and fortunately we were able to avert that. But so things were cheaper then, but you were taking much greater risk. Today, if you were to argue on a risk-adjusted basis, we're finding some stocks that are pretty close to as cheap as then, and we don't think we're anything near Armageddon, though there certainly is a scenario that one can concoct. And I'd point particularly to the financial sector. Citigroup, Goldman Sachs aren't too far above in terms of a price to book or something ratio that they were back then, but they're massively less leveraged. The external
So you're still buying
shocks.
financials?
Well,
Or
we
you're holding?
were short financials like crazy in 2008, and that sort of saved us on the short side because our long book got killed, of course. And we had basically, so we made 2 or 3 times our money in American Express and Wells Fargo, playing them off the bottom in early '09. But then we exited those and we only got back into financials in August. So we bided our time, waited for them to get very cheap, and we think sort of big cap U.S. financials today are actually pretty cheap.
Would you include Bank of America in that category?
That's we own a 0.2% position in Bank of America, so not really. It's just too
so you're not like
uncertain.
Fair Home Fund?
No, we've sort of, but we're in Citigroup in size, and we actually think they're, people sort of lump those two in together. Citigroup's trading at almost half tangible book. B of A is trading at about 56% discount to tangible book. So B of A is a little cheaper, but they're both within a range, same level of cheapness. But we like Citigroup a lot more for 2 reasons. One is the bad bank part of the way to think about both companies is you've got some good businesses, call it good bank, and then you've got some runoff businesses and some things with uncertain liabilities, etc. Bad bank. Citigroup has in fact explicitly structured their business where they have a $300 billion, not quite, in assets bad bank they call Citi Holdings, and then there's Citigroup, which is the good bank. So bad bank is a little more than 15% of assets, but that's all that investors are focusing on. Well, we like Citigroup because better than B of A for 2 reasons. One is we think bad bank is less of a black box, has less risk. We feel more comfortable that isn't going to blow them up.
Is that primarily mortgages?
About 2/3 of it is U.S. mortgages, both first liens and second liens, and every quarter you can look at the mortgage trends, and all the big banks are sort of kicking the can down the road on the mortgages, but you can't kick the can down the road on what percentage of mortgages missed their first payment, went 30 days delinquent, right? Well, you can actually track that data, and the trends have actually been fairly stable, even improving in bad banks. So that gives us some comfort there, and they also have some pretty good assets in there as well, but that they're trying to sell or run off. But the real reason we like Citigroup better than B of A is we like good bank better. Citigroup has a fantastic international franchise, highly profitable. They have something like 40% market share in Mexico, 40% market share in Korea. They generate 2/3 of their profits in high growth emerging markets. So someday we have to figure that investors will take their eyes off the fixation on 15% of their business and look at the other 85% and say, hey, this is a heck of a business. And it's being managed fairly well to, as they run down bad bank, the good bank is performing very well. So we think it's probably, if you net out the downside of bad bank and the positives of good bank, it's probably worth book value, tangible book, which is about $50 a share, and the stock's at 26. So, we can make a very nice return, even if it takes 2 or 3 years for the market to sort of come to its senses on this one.
So in a sense with Citi, if Weil hadn't done anything 12 years ago, that's in essence what Citi's going to become again today.
Yeah, I mean, the stock, you have to keep in mind there's a stock split in there, so the stock's down about 95% from its peak, but in terms of
the
building
acquisitions and all the stuff they did,
yeah,
mortgages.
I mean, I think they created something that was very unwieldy and almost impossible to manage and to correctly see risk. And so they took on...
Too big to succeed.
Yeah, they took on too much risk, and it really blew them up. I was actually just looking with the recent retirement of Bill Miller. I was reading an interview with him back in 2005, the last year, when he, of this 15-year streak.